So that's my comments on REITs. I have pulled out one to do a pulled pork on to expand on that. And I'm going to use one of the ones that Dave has asked for. I'm going to use COF, Centuria Office REIT. And the only reason I picked that out of the three, well, first of all, Cromwell was a falling knife. It's a negative sentiment. So I thought that wasn't worth doing. Eleonora has a higher QAV score of 0.07 than Centuria, which has 0.04, but it's a low ADT stock. So I thought I'd do one which was meaningful. So Centuria Office REIT has just under $1 billion traded every day. It's 949 million. So it's large enough to be of interest to everyone listening. However, it's not above its buy price, even though sentiment is increasing at the moment. So eventually that gap will narrow because the buy line, because sentiment has been falling, the buy price gets cheaper each month, and the share price of this REIT has been increasing. So it will cross, I think, some stage in the future, in the near future anyway, all things being equal. The REIT itself contains $2.2 billion of office space across 23 buildings around Australia. Most of those, it does have some CBD assets, but they make a virtue of the fact that they are on the fringes. So if you think of places like Chatswood in Sydney or the Valley in Brisbane, 42 Valley in Brisbane, that's the kind of office buildings they have. So they are calling out that the work from home trend hasn't affected it as bad as some of the REITs that just have exposure to CBD office buildings. They do have 97.1% occupancy, which is up from last year of 94%. So there is a trend coming out of COVID to return back towards full occupancy. A couple of other things that are interesting about this one. Something you should take into account with REITs is what's called the WALE, the WALE, which is the weighted average lease expiry. So the longer that is, or the higher the number, the better, because it means you've locked in long-term tenants. For this company, it's 4.2 years on average. So that's kind of in the middle. It's not short, it's not overly long, but 4.2 is not bad. And the company is 36.7% geared. So again, a modest gearing rate, not overly high there as well. I went through their latest projections and their latest releases, and they're claiming that the return to work is gaining momentum. I guess they would because it suits them, but it's probably true. As we hear, I mean, I read articles every week about this company or that company telling people they won't get their bonuses if they don't come back to the office, or they've got to be back in the office for at least a certain number of days a week. So there is some trend back towards that, which will help these REITs. The other thing that helps this company is that because they're in those kind of fringe CBD buildings, they tend to be a bit newer. So their average age for a building is 17 years, which is reasonably low again for these kinds of REITs. And that also makes them more attractive because people like renting from in your buildings, especially if they're not in the CBD. If you have two buildings and one's old and one's new, you look for the new one. The call out though on property valuation has to be made, and the property valuation went down 4.2% this year, which is a $98 million hit to profit. Even though it's treated as an abnormal, it really is a change that the accounting standards put through the P&L. So that's one of the reasons why these REITs are trading below their NTAs. People don't think 4.2% is enough of a devaluation to office building property. But again, eventually that will sort itself out. And for the moment, you are buying it at well less than NTA. So if I can, NTA on this company is $1.96, and the share price I did my analysis at was $1.36. So big difference there. Do I think that the NTA value of these office buildings will fall by 30%? No. So we are picking up stuff at cheap, and as Dave said, it's a contrarian investment and a value investment. So that's good. Going into the QAV numbers, the share price is less than the consensus target. So That's a tick for us. It's round about IV2, but above IV1. So IV2 is $1.35, but the share price is $1.36.5, so doesn't get a score for that. Earnings per share after abnormals is less than 15, or it's negative 15 cents. So it's not going to score well for us on that basis, and it's down 32% from the year prior. Forecast EPS is forecast to grow at 19%, and forecast EPS is 14 cents per share. But I haven't been able to tell whether that's before or after abnormals, so I'm not sure how much stock to place in that. But it does get a score at this stage, so I'll take it on face value. It gets a score on the growth out of PE metric, because the PE, well, it's negative, I think, in this case. No, low anyway, because they're using the pre-abnormal PE. So it beats our threshold of 1.5 for growth out of PE, which is 1.64 in this case. But I do have a question mark on that, whether it's pre or after abnormal. So in other words, if there are more write-downs next year, that growth for PE won't hold. Conversely, if we decide that people are going back to the offices and they're worth more, then there'll be a valuation increase, which will support profit next year. Stock Doctor Health in trend is strong and steady, so we score it for that. The dividend yield on this company, which is a focus for investors, is 9.56% unfranked. So that's getting up to the top of the sort of market again, and it's quite high. And so I think just that fact alone will see some support for the share price going forward. NTA, as I said, is $1.96, which reflects skepticism in valuations. Net equity per share is the same, so we're not seeing any goodwill there, which is good. Prop CAF is 12.5 times, which is why we're not seeing it on the buy list. And there's no owner founder, so we can't score it for that. So all in all, summing all those up, quality is 7 out of 14 or 50%, and the QAV score is 0.03, which is too low for our buy list. But anybody who wants to invest in this sector, can either buy something when it comes on the buy list like URW, or could look at buying things when they're below their net tangible assets and getting them at discounted prices, which I think is a valid strategy, particularly if you're after a good yield to live off. 9.56% is pretty good in the market.
Thanks,
so, Dave,
Tony.
I hope that answers all your questions.